This is not a signal and not a forecast. Several hourly candles have formed since this snapshot, and what matters is that the structure has not resolved, it has only spent time. At published time, price is still interacting with the same reference, so the question remains unchanged. This weekly recap starts where the market sets its widest boundaries, because on higher timeframes, the most important information is not a single intraday move, it is how a month behaved over time, how it approached a boundary, how it hesitated, and how it finally chose to close. On the monthly chart, January traded under a downtrend pressure line. It also came up underneath an ascending support line, and it traveled far enough to press into the zone of the monthly 20 moving average, which is where markets often slow down, not because it is magic, but because it is a commonly watched mean that forces time to be spent. But the key detail is not that it reached the 20 MA area, the key detail is the close, because the close tells us whether the month accepted that mean or only tested it. January did not finish above it, it closed below, and that matters because a monthly test followed by a failure to hold is not resolution, it is an unfinished question that gets carried into the next month. Now look at volatility, not as a fact but as a process. The long-term Bollinger Bands have been transitioning from a more open, energetic phase into a tighter, more controlled phase. The upper long-term band had already begun to close in, and more recently it looks slightly pressed down, not collapsing, but losing lift. On the other side, the lower long-term band still points upward, but the slope is no longer as strong as it was, which is the market's way of saying that the floor pressure is no longer rising with the same confidence it had before. At the same time, the short-term Bollinger Bands tell a different story, because since the squeeze that formed around October 2025, the short-term bands have expanded aggressively, then kept expanding, which is exactly what persistent volatility does. It does not simply spike and end, it expands, pauses, expands again, and forces price to travel further away from the center before it can even consider calming down. RSI fits into that same time story. After Divergence appeared and developed, the market did not immediately flip into a clean trend. It moved through the aftermath, it tested the mean, and then it lost the 20 MA, which is not a prophecy, it is simply a sequence. Divergence develops, momentum cools, price reaches the mean, then it fails to keep it, and RSI drifts lower rather than snapping back. So the monthly candle is not telling us what happens next, it is telling us what remains active, a market that tested the monthly mean, did not hold it on close, and is still carrying a volatility regime that began with a squeeze and expanded into a wider, less forgiving environment. Now we step down one layer, because weekly structure is where the market reveals whether that monthly boundary is being respected through time or whether it is being negotiated. On the weekly chart, the down leg is visible as a sequence rather than a single event. The market moved from expansion into stress, then it slowed, then it tried to rotate, and each attempt to stabilize has had to occur inside wide volatility conditions, not inside calm, compressed bands. That is important because when weekly volatility is still elevated, price action can look sideways while the underlying conditions are still tense. Watch the Bollinger behavior here as an evolving state. After the heavier weekly expansion, the bands do not immediately collapse back to normal. They tend to pause, then partially contract, then pause again, and that's what the chart suggests. The expansion has eased, but the structure has not returned to a narrow, balanced channel. Upper versus lower band behavior matters too because the upper side looks heavier, less lifted, while the lower side has stopped accelerating upward, which matches what we saw on the monthly chart. Volatility has not reset, it has only changed pace. This is where moving averages become a distance condition, not a directional tool. The weekly 120 moving average is not something we use to call a bounce or a breakdown. We use it to measure whether price is being pulled back toward a long-term mean, or whether the market is willing to tolerate separation. And right now, the separation is the story, because distance began to show, then it persisted, and once distance persists, it becomes a condition the market must either reduce through time or accept as the new normal for a while. RSI on the weekly chart supports that same idea. It moved into a depressed zone, it attempted to stabilize, it produced small rebounds, and those rebounds stalled, which is what weak recovery looks like in process terms, not a single reading, but a sequence of attempts that do not build. That doesn't predict a next step, it simply tells us the weekly engine is not strongly re-accelerating yet. So the weekly chart is not giving a conclusion, it is giving a constraint. Volatility has cooled from peak stress but remains elevated. Distance to the longer mean is still in active condition, and momentum is stabilizing more than it is rebuilding. Now we go to the daily chart, not to chase detail, but to see how the market is spending time inside the weekly condition, because daily structure is where unresolved becomes visible as repeated hesitation, repeated tests, repeated pauses. Start with the moving average relationship, because you already described the most important monthly event. RSI divergence developed. The market moved toward the 20 MA and then the 20 MA was lost. On the daily chart, that loss is not one moment, it is usually a sequence. Price presses into the area, stalls, slips under, tries to reclaim, fails, then begins to rotate below it. That sequence is exactly what a market looks like. When it is not accepted back into the mean, but also not collapsing into a clean trend, it is spending time under a reference. Now place Bollinger behavior on top of that, again as a process. After the short-term bands expanded from the October 2025 squeeze, daily volatility did not simply stay constant. It pulsed, it expanded into sharper moves, then it paused into a narrower rotation, then it re-expanded again, and this matters because pause can look like a base, but in an elevated volatility regime, a pause is often just time being spent, not a resolution being formed. Upper versus lower band behavior gives you the tone of the daily environment. The upper band has had trouble lifting away cleanly, and when price approaches that side, it tends to stall rather than glide, while the lower band has allowed deeper excursions, which is what stress looks like. The downside has room, the upside has friction. And when bands do begin to contract slightly, the market does not automatically reverse. Contraction can simply mean the market is conserving energy inside a range, waiting for acceptance to be decided. Now look at the weekly 120 mega-amperes condition from the daily perspective. This is where many people make a mistake. They turn distance into direction, but we do not do that here. Distance is simply a condition that can be reduced slowly, through repeated daily closes that drift back toward the mean, or it can be tolerated through continued rotation that keeps price away. The daily chart right now reads more like tolerance than reduction, not because it must continue, but because the time spent away from the mean has not yet been paid back with a consistent reclaim sequence. RSI on the daily chart should be described the same way. It dipped, it tried to stabilize, it rebounded, then it stalled again, and the important thing is that the rebounds have not stacked into a sustained climb. This is not a bearish claim, it is simply describing the engine state. Daily momentum is not in a clean rebuild phase, it is in a recover, pause phase, which often pairs with rotational price action under a moving average reference. And this is where your trend lines matter, because you describe January as sitting under a downtrend boundary while pressing near an uptrend support boundary, and that is exactly the kind of compression that creates long-lived uncertainty. When price is wedged between opposing constraints, it can travel a lot intraday, while still remaining structurally undecided. It can test, reject, retest, and still not resolve, because resolution requires acceptance, not movement. So the daily chart is not here to add urgency, it is here to justify patience. A market that lost the monthly 20 MA on close while weekly distance remains active, and daily volatility is still pulsing rather than calming, is a market that tends to spend time. It rotates, it probes, it stalls, it repeats. That repetition is not noise, it is the market failing to complete the same task over and over again, which is exactly what unresolved looks like. We end this weekly recap the same way we began it, not with an outcome, but with a question that is still active. The monthly mean was tested but not held on close, the weekly mean distance has not been resolved, and the daily chart is still rotating inside a volatility regime that has not fully reset. Until those conditions change through time, the most accurate stance is not prediction, it is observation, because the market is still interacting with the same references, and it has not finished answering the same question.